Hi, good morning, everybody. Welcome to the Morning Cuppa. The RHB Economics Research has published our quarterly report as of yesterday night, and I think that probably is a good time to speak about the global markets as well as our views on the global economy into the next year. And I think that probably we could share some good news as well into the coming year. Yeah. So I think really despite global headwinds in the rising geopolitical tensions and divergent policies from central banks, we are actually seeing that the markets have actually shown some remarkable resilience, into the year to date into September, October this year. And of course, we are seeing that essentially recession fears have actually receded, very sharply, as compared to where we have seen at the start of the year. So I think generally, if you see where the markets are right now, really from the equities point of view, investor sentiments have held quite strong. Yeah, we've seen that is essentially equity markets have gone up. US equities have been performing very well. Malaysia KLCI has actually reached a 1600 handle again. So I think what does this mean? It basically means that the global markets and investors, have remained in risk-taking, mode, and this has also been reinforced by our RHB Risk Sentiment Index, or our proprietary model that has been built by our team back in RHB, that essentially shows that markets still continue and will likely still continue to remain in risk on mode into the fourth quarter, if not into early 2026. Across South Asia, and especially ASEAN, growth has actually softened slightly but remains solid. We are forecasting at least ASEAN 6 GDP to actually moderate to 4.4% for this year, before recovering to 4.6 next year. So I think in a very quick note and a very quick observation, really, that next year, by and large, in a very large possibility point of view, next year will likely be a better year. And if you are looking at, say, domestic demand, favorable policies, and improving trade, all this will likely come into play as well, into the 2026, into next year as well. And this will likely continue to offset the global, drag that could actually be seen into the fourth quarter, if not next year. From the inflation point of view, I think one of the key concerns for recent years, is finance softening. Prices of essential goods, such as oil and food, are easing. Central banks have room to breathe. We have already seen rate cuts from the Fed and from Bank Indonesia. And of course, Malaysia's OPR has also been, reduced by 25 basis points, in the earlier part of this year. So I think we can look forward to lower interest rates environment, into the fourth quarter and into next year as well. And this will continue to fuel, what they call, domestic demand, as well as, investor confidence, as well as cost of funding starts to decline and continue to decline into the next year. Um, if we look at fund flows as well, fund flows have been encouraging. Yeah, global investors have continued to show, strong appetite for equities. Malaysia is seeing a pickup in both bonds and stocks inflows. The ringgit has stabilized, and I think overall we can see the FX reserves are building. We are seeing that potentially, there have been a strengthening of the ringgit, and that could continue to persist, towards the year end. And of course, Malaysia, we are still keeping our growth forecast at 4.2% for this year, and essentially rising to 4.7 next year. A lot of key strength really from our home ground semiconductor exports still directly linked to US firms operating locally, which could actually provide some insulation from trade tensions, and of course the recent data on industrial production, and in some sense, trade exports as well has still continued to stay above water, and that has actually mean that even though it might slow, the contraction might not even be seen into the fourth quarter of this year. So this is good news, but I think maybe from the global economic point of view, we should be cognizant on the risk as well. And of course there has been structural weaknesses, emerging from the global lineup, like the US and China. In the US, you're seeing that, the labor market is beginning to show signs of cracks, seeing that, essentially the jobless claims have been rising, wage growth is slowing, the hiring is softening, and the unemployment rate is actually rising above 4%. And this will actually likely be one of the key concerns from the Fed as well as they move into 2026. And that could mean that the Fed into this year, fourth quarter, could see another one more cut from the Fed fund rates point of view, even though they may still stay cautious on cutting rates further for this year, given that inflation still remains to be quite high, and could actually elevate into fourth quarter. Next year, we're still looking for about probably two more rate cuts by the Fed, in the Fed fund rates point of view. And in China as well, I think the recovery still remains sluggish. GDP growth is stuck. Even though it's above 5% in the first half, it could actually fade into sub 5. Given that the high frequency numbers have been slowing, and we are seeing some key weakness as well. The sales are, retail sales are flat, property prices still continue to decline, and we are seeing that high frequency data such as business confidence, credit growth is weak, and there's a rising possibility of a prolonged structural slowdown in China. So all these are likely going to impact ASEAN, given that we are very trade reliant, especially Malaysia. Exports to US and China, from the ASEAN point of view has already been weakening. And this is very much a key concern, at least from the external point of view, from Malaysia and from ASEAN. And that, for that matter, that's why we are still looking at a weaker growth of 4% for the second half for Malaysia, as compared to 4.4% in the first half of this year. And I think one thing that we should always, pay attention to is tariffs. We have seen that tariff fears have receded, and markets are, somewhat, desensitized to what Trump is saying, what the U.S. President Trump is saying, at this juncture. And the equity markets and investor inflows continue to stay strong. But let's not, keep our eye off, the tariff risk, given that there is still remains to be, some of the risks, pertaining to sectoral tariff, such as semiconductors and pharmaceutical. There has been announced, that pharmaceuticals may see, and will see higher tariffs, into the days to come. And that could mean that the intensification of tariff risk in 2026 must be accounted for, and that could actually derail our somewhat cautiously optimistic view for the global markets and Malaysia. And probably last but not least, one key risk that we should also pay attention to is geopolitical tensions. But unfortunately, this risk is more of a black swan risk. It's highly volatile, and lack of clarity, and basically means that economic modeling remains to be not prevalent, and not available, to try to forecast how tensions may pan out. But if they do, given that where tensions are right now, we have seen, the tensions in Indonesia, in Doha, as well as the attack on Ukraine from the drone strikes. So I think essentially we have, markets have been shrugging off this risk. But if this risk starts to intensify into next year, then probably we should see a rapid return to risk-off behavior. What does this mean? It means that probably safe haven demand is going to increase. That would mean probably lower US bond yields, higher gold prices. Even though gold prices are in records high right now, we still see higher gold, given there's a preferred safe haven, higher oil prices, and probably renewed market volatility into 2025 and 2026. So how do we, position from investors' point of view, from the market's point of view? I think at this juncture, we still propose a strategy of cautious optimism, balancing conviction with flexibility. As asset allocation, I think at best, stay nimble, even though we still remain overweight on equities at this juncture, from the US, Malaysia point of view, but be ready to rotate to defensives, especially, if risk aversion starts to return, defensive assets will likely still, pertain to fixed income, and some safe havens such as, gold, and the safe haven currencies like the Japanese yen. Interest rate strategy, probably, we are looking at a lower interest rate environment. We are seeing that central banks have been cutting rates. The Fed will cut rates even further for this year and next year. So please position for a structurally lower rate environment into 2026, into the next year. And that basically means, extending durations on bonds, and probably with a better economic prognosis ahead, then probably shift into more IG credit could actually be something that will pay out into the next year. And probably last but not least, given that the US dollar will be in structural decline from the currency outlook point of view, then probably we should start to continue to stay short on the dollar into 2026. And what should we buy then? Probably high beta currencies, that are growth related, such as the Aussie, the Kiwi, even the ringgit and the Sing, and that could actually mean that this would be the better buys from the FX point of view against the dollar, against the weakening dollar into the next year as well. Yeah, so thanks for the time. Let me pass on to the next speaker. Thank you.
Thanks, Barnabas. So let me move on to our outlook for Malaysia for fourth quarter. So actually for 2025, we still maintain our GDP growth forecast at 4.2% for Malaysia, underpinned by a robust domestic economy. So next year, we are looking for some improvement in Malaysia GDP, where we pencil in a GDP growth forecast at 4.7% for next year. So supported by continued support from the domestic economy, with some improvement on the external sector actually expected on next year. So however, for second half, economy is expected to sustain growth at 4% as well. So versus 4.4% in first half. So basically underpinned by robust consumer spending, a healthy labor market, steady investment activity, where investment spending was pretty robust in the first half with a double-digit growth of 10.5%. So we think that this momentum is expected to be extended into second half amid a sustained strength in structural investment, as well as machinery and also equipment spending. So coupled with supportive domestic economies. So Malaysia domestic economy continues to demonstrate resilience driven by a solid consumer spending and also steady investment activities. So private consumption is expected to be supported by favorable labor market condition and rising household incomes. So with gradual and orderly rollout of fiscal measures such as expansion of SSD and retargeting of rural and youth subsidies is expected to have limited impact on consumption and also inflation. So several domestically oriented industries remain relatively insulated from global uncertainties and are expected to stay resilient, so which including retail and consumer goods, construction, healthcare, education, and utilities will continue to benefit from strong local demand. So despite our relatively optimistic view on the Malaysia domestic economy, so we stay cautious about the potential external weakness as slower trade performance is expected in the months ahead, so which already seen in August pre. So with a dissipation of front-loading activities and also the gradual impact of tariff. So export-oriented sectors such as E&E, raw materials and machineries are likely to be most affected. So even so, several factors will still support the export performance in the second half, which including more clarity on US reciprocal tariff on Malaysia, which is at around 19%, and it is broadly aligned across the ASEAN, so which will actually continue to support the Malaysia competitiveness. So and also extension of US and China trade truce to November should provide some short-term relief and also improve the manufacturing sentiment as well. So inflation front, we still maintain our 2025 inflation forecast at 1.6%, so well within the official range of 1.5 to 2.3%. So inflation is projected to remain manageable at 1.8% in the second half versus 1.4% in the first half. So with domestic policies such as SSD expansion, wage adjustment, and electricity tariff reform may actually aid some price pressures, but their overall impact is expected to remain contained given the gradual and prudent implementation. So SSD broadening is estimated to raise the inflation by only 0.1 to 0.2%, while the electricity tariff adjustment under the new AFA mechanism may actually cause some monthly fluctuations. So we expect the OPR to remain at 2.75% at the November MPC meeting, which is the last scheduled MPC meeting for this year. So as we see now, the domestic demand is still remain robust, coupled with a manageable inflation. So current developments, including signs of easing global tariff and trade tensions, alongside with solid domestic demand, do not suggest another OPR cut for this year. So looking ahead into next year, we do see that monetary policy to remain data dependent. So contingent upon factors such as impact of tariff policies on Malaysia trade performance and also the momentum of the domestic consumptions. So in terms of fiscal front, we believe that the 2025 fiscal deficit target of 3.8% of GDP is attainable. So supported by expansion of the SSD and also subsidy reforms. So for the upcoming budget announcement on 10th of October, we do forecast a narrower deficit of 3.5%, with around 86 to 89 billion allocated for the development budget. So the central priority will be on promote a sustained and inclusive growth amid a complex global environment. So that's all from me. I will pass the line to Vincent. Thank you.
Thanks, Sian. I'm Vincent here to present the midweek futures traders technical brief. This is week 1, October 2025. Here we have seen the movement in some of the setups for our most popular products. Notably, we have seen that the US indices have moved into more neutral positions, including forcing the Nikkei as well also the China index into a neutral stance here. I think this is all mainly due to the fact that there has been a very good run and there has been some profit taking and also some maybe consolidation in the offing. And also, this may not become a full-blown sell-off because I think in the space of futures or derivatives, there has been some hedging that's been going on in the indices to take precaution in case the market is really correct. Otherwise, the metals are still very strong. Gold, silver, and copper. In fact, one of those which we don't cover, platinum, has also been trading on a very positive note. Crude oil remains very neutral. We move on to palm oil, whereby we see that there has been also a slight downtrend and more like a neutral trading pattern. This is mainly due to news that the expectations of lower stocks in the coming weeks ahead and has cushioned the selling pressure on palm oil prices. And here we have the commitment of traders for US indices. The S&P 500 has registered an increase in short positions by an estimated 20,000. The Nasdaq reduced by 7,000 of shorts. And in fact, the Dow saw a drop of an estimated 9,000 in net long positions. So we can see the movements of traders here, and mainly, as mentioned, it could be hedging activities that we are observing at this time. We want to focus on the crude oil here. The crude oil overall positions has decreased in long positions by an estimated of 4,000, and natural gas oil short positions reduced by an estimated 9,000. And as we know, and have seen that crude oil prices have been trading very much in the range, and therefore for today, we will also be looking at a setup for a possible entry level at lower because the range is likely to be maintained. And the news that has been affecting movement of crude oil prices have been basically by the outlook for larger OPEC and OPEC plus crude production. According to OPEC delegate, the group may be expected to discuss fast-tracking latest round of supply hikes in 3 monthly installments of about 500,000 barrels starting in November. So looking at the situation, we feel that there is going to be some downside here, but due to the fact that crude oil has been trading in neutral positions, we will be looking at a possible short-term trade setup here at the current price of 62.45 and the reference price at 60.70, which is still slightly an estimated of about $2 lower. And If that happens, the potential profit price will be 63.5, giving a value of $280. And if that goes strong, then we have got a cut loss level below the 59.50, which will give us a loss of a USD 120. Moving ahead to metals, we have the commitment of traders here, and the movements of the positions in metals basically is of one which is a global concern about central bank not comfortable with the fiat currencies, and also the economic news that actually consists of the core inflation, falling central bank rates, and also exceptionally large budget deficits in many of the world's largest economies. So for metals, definitely it has benefited from these concerns. Here we have the chart for copper, which we are covering today for our market guide. And we have seen that there has actually been a slight uptrend here for copper. And basically, copper prices have been stepping out due to supply concerns. Indonesia's second largest mine in the world has declared a force majeure recently on contracted supplies due to a fatal mudslide accident. The Grasberg mine is responsible for 3% of global copper supply, and it suggested that the full recovery of output is not likely until 2027. So indeed, there may be some short covering happening in the copper space. So for these, we are basically on a short-term positive for copper. Pardon me, over here there is a typo. It should be positive. The reference price we are looking at is 4.8520, and potential profit price that we are looking at is 4.95, which is a value of $245. And if there is anything which goes wrong in this setup here, the termination price is below the 4.75 level, which will give us a loss of USD 250. So that's all I have for today. I'll pass on to the next speaker. Over to you, Joseph.
All right, morning everyone. Thanks Vincent for the weekly futures update. Today the Hong Kong market will be closed for the 1st October on the National Day of China. But the market will resume tomorrow. Meanwhile, just to mention that over at the US, the HXC, which is the Chinese index that trade in the US, continue to trade. If we are looking for some Chinese stocks that in the US market, right, I will be looking at the this counter known as SE at the US market, which is C Limited. So right now you can see that the C Limited is undergoing a corrections touching the 178. So if tonight there will be a correction, so I will think that possible bottom fishing near the support which is 160 and 170. Okay, and so looking at the yesterday night market, I can see the XSXP, which is the Europe index, as well as the XPX continue to move higher. Sentiment remains risk on at the US market right now. So slightly move back towards the Hong Kong and China market. We do see that the sentiment is very strong on the commodity related counter. Like yesterday, Zijin Mining continue to move upwards. Now another gold retailer, which is Chow Tai Fook, I think, right, once the momentum pick up pace again, it should also follow suit on the gold price to move on a high basis. Now meanwhile, just to look at the big cap, which is the AI related counters, right? Tencent, Alibaba, and GDS. These are the three counters that will be follow on the tech stocks at the Hong Kong, together with SMIC, which is 981. These are four counters. Okay, and At the Malaysia market, right, for FKLI, we still remain bullish buyers that FKLI is going to break on 1620. FCPO, right, underwent a correction yesterday, right, struggling to stay above 4350. So on the downside, it should test the 4250 and followed by 4150. On the upside, we set our stop loss at 4006 for FCPO. Right, and trading stock firstly this morning, we'll be looking at KBJ Healthcare. The break past RM2.73 resistance. Next resistance is RM2.86, followed by RM3. AWC also break above 67 cents on the high volume. Upside resistance 72, followed by 75.5. BM Green Tech about to right now is undergoing consolidations under RM1.65. So in the event that it break past 165, right, it should climb toward 172, followed by 179. On the downside, it should rebound near the support at some where RM1.58 for BM Green Tech. Now, meanwhile, Rand Hill is consolidating between 197 and 185. So if the breakout happen, Rand Hill will be testing RM2.10 and followed by RM2.20. So we have breakout stock KPJ, AWC, pending breakout BM Green Tech, and also pending breakout Rand Hill. Right, I'll stop here and pass on to Siang on the VS result update. Thank you.
Okay, thanks, Joseph. Morning, everyone. Let me continue with a results note on VS Industry. Essentially, the company reported their fourth quarter results yesterday, and the results were below expectation, given the lower than expected profit margins. I think few reasons here. Firstly, the low volumes, which led to lower utilization rates as customers hesitate or take wait and see approach in reaction to US tariff action move. So secondly, there was also a cost down or cost sharing request by a key customer to share the new tariff burden. So it was booked in this quarter as well. And thirdly, the operational losses by its Philippines operations in regards to the startup of the new operations there. And of course, I think if you look at it, HT Press, one of the VS's subsidiary, was also incurring quite a major losses due to the low utilization rates after the loss of a key customer. So in this quarter, they have also put in some impairments on PPE with regards to HT Press, as well as an impairment on receivables as well. This is in relation to customer Y, which is filing for bankruptcy. So that with all this, VS reported a 73% slump in core net profit to 54 million. I think if we look forward, we can anticipate an immediate earnings rebound in first quarter as volume has started to recover, driven by favorable year-end seasonality and secondly, the new product launches by some of its key customers as well. So this should translate to higher capacity offtake for HT Press, the one that I mentioned just now, the loss-making subsidiary, as this subsidiary is specializing in tubing or anodizing. So when VS starts to produce more vacuum cleaners, then it will result in higher capacity offtake and reduce losses for this subsidiary. Meanwhile, for Philippines operation, it should also see narrower losses going forward, given that they have started to internalize or produce parts internally in Philippines rather than to import from Malaysia starting August. And they will have the second production line starting in December 2025. So with the higher utilization rates and better efficiency, this should lead to a break even by March 2026. Meanwhile, I think another angle to look forward to will be the potential of new customers, given that the demand pickup from brand owners trying to diversify their production sources in reaction to the US tariff move. Post results, we are revising down our numbers by between 5 to 10% to take into account more cost down demand from key customers, and we roll out FY28 earnings forecast. Having said that, our target price stays at 78 cents as we revert to an undiluted share base as we deem the warrant conversion unlikely given the conversion price and period to expiry. So all in, we maintain buy with target price of 78 cents. We are forecasting a 75% 3 years earnings CAGR. This will be underpinned by market share gains with customer X, turnaround of loss-making operations, and of course the new orders from the emergence of trade war diversion opportunities. That's it from me. Thank you so much. Thanks for joining us this morning. Happy trading, and we look forward to seeing you in the next morning kappa at 8. Have a good day ahead. Thank you. Bye.